What do you do in a changing economic environment like we're experiencing here in Q4 2022? I'm Jamie Gruber here with the Quantum Capital team, Mark Henteman, Cliff Chung, Nick Ameluxon, and we're going to talk about that topic today. So let's throw it out there. Mark Henteman, I want to go to you first. You've been through a couple of different cycles, 2 or 3 different cycles, going back to the .com, the '08, and now coming up on whatever there is to be. What do you do? So it's hard to find deals. What are some things that you do? What's your first suggestion for investors?
First suggestion. Well, I mean, for a little bit of context, like 30-year mortgages are over 7% now. A year ago, they were down at like 3.1. And so the cost of owning a home has increased by 80% in the last year, which is keeping people out of homeownership. And so there's millions of people who can't afford homes. Construction has ground to a halt. There's a housing shortage and construction is not keeping up with demand. And so all those are sort of positive forces in the multifamily space. But as usual, multifamily is impacted by economic forces that both benefit it and hurt it. And the big thing that's hurting multifamily investors right now is obviously the cost of debt. So, we've got to try to figure out how to navigate that environment.
Yeah, makes sense. What are some strategies, Nick, that you see being maybe a strategy, something that you're seeing? Okay. I just talked to a guy today who's saying, I got money to place. I need the tax write-off, right? By the end of this year in 2022, but no one's doing deals. And that's, I think there's a stalemate right now. Sellers want July prices. Buyers want whatever March 2023 prices are supposed to be. And, there's a stare down happening. So
right.
What are some other ways, Nick, that you see or another way, the ability for an operator like Quantum or anybody else to move forward and maybe acquire a deal?
Yeah, I mean, this doesn't really help you move quickly, but be patient. Right now, there's a ton of deals that are out there. They're just sitting. So there's not a lot of, new deals coming to market. There are some, right? But, a lot of them, the pricing is still yesterday's pricing with today's debt. But we're seeing those prices slowly come down, week by week as they're not trading. If a seller has a reason to sell, if not, they're just taking it off the market. So just be patient. And then, another thing is look for debt that's assumable. I mean, creative ways to buy it, owner financing, assumable debt. We just purchased, this is a unique situation, but we're purchasing a property all cash in the current environment. We're getting a great price. It's a good time to get great pricing, debt outside of it. If you can be patient or creative.
Cliff, all cash buy. How do you buy a property all cash? It sounds like, Mark's running around just throwing money out of his pockets. How do you buy a property all cash? How does that work?
Well, other than winning the lottery, it's a really good idea to constantly work with your network, work with the people that people that are interested in doing deals, people that have capital to place. Circumstances that Nick referred to about the deal that we're going to close tomorrow is that we are working with an investor that has a large amount of 1031 exchange funds. And it really helps us to avoid and mitigate the risk of interest rates right now being locked into something that might be a lot higher than what we're used to. That would make deals not pencil out in today's environment.
Yeah, 1031 could be a magical thing when you have that kind of. Well, in this case, we had a lot of funding, somebody who did it the millionaire next door way, right? It bought property a long time ago, sat on it for a while, and then said, don't want to do this anymore. And voila, a lot of money into their pockets as a result of a sale of property.
Yeah. And I would say no matter what is going on in the economy, you can still always invest in relationships with people. And I think that having an open line of communication with people that that are your mentors, people that you mentor, I think that will help to facilitate a lot of opportunities, whether or not it's now in today's environment or 2, 3, 4, 5 years down the line.
Yeah, it becomes a long game, really, especially when you're, like us, we have investors, we've had consistent deal flow for a long time, as most operators have. And now things slow down a little bit. Although the deal flow is coming in, it slows down in terms of our ability to buy and do the right thing for the investors with the kinds of prices that are being asked of us right now and the debt terms that are available to us. But you're right. The long game is, hey, We continue to deliver on the properties that we have, and as most operators will, or I hope they will. And we facilitate discussion and educate our investor base. Mark, you talk about building a community of investors, right? Like building that community with your investors, because there will be buying opportunity. It's coming. It definitely is coming. It's just a matter of, how well positioned are we in investing in your network makes sense.
Yeah, if it's not making sense to buy at this moment, you could work on other aspects of your business. Cliff, like you mentioned, relationships are a great thing, and get your systems down. Like sometimes you're just racing 100 miles an hour doing deals. And now is a good time to look into the corners of your operation and what needs attention.
Mark, are there any other things you would say people should be thinking about in this environment? Other thoughts or ways of going about their investment strategy?
Yeah, I mean, I think of it as like interest rates are the big ogre looming in the multifamily space. And otherwise, the fundamentals of multifamily are great right now. But interest rates, almost everybody uses debt, and debt is extremely high at the moment. So you kind of have to invest around interest rates. That's got to be your strategy. And how do you do that? Yeah, you can buy all cash as an option. Motivated sellers are out there now. All those people that did not lock in fixed debt, their costs are going through the roof. So I think you can take advantage of that. I think there's opportunities there, but you got to be able to navigate, the interest rate environment. Like we said, if you can avoid getting debt and delaying it, maybe like we're doing, buying all cash, executing the value add plan, and then refinancing once rates go back down, and ideally pull a 100% of equity out of the deal. That's a great approach. Other things to do in this environment is revisit buying off market. If you've paused, in the last couple of years, there was such a frenzy and prices were going so high. Every seller wanted to expose their property to the full environment. So they were willing to pay those pretty hefty sales commissions on deals. But now I think that deals have slowed down. It's a good time to reach out to sellers off market. Many who can be motivated. And since returns are so narrow and so thin now due to interest rates, I think you can, a lot more sellers will be open to selling to somebody off market.
You think you hear about, like you said, motivated sellers coming up against debt terms, didn't lock in a fixed rate, so on and so forth. I just think it's a good opportunity to talk about, okay, well, what about our portfolio? How do we prevent that from happening? How do we prevent ourselves from being in a situation like that? Like, how are we able to maintain ourselves through this? What has our philosophy been with our debt, with how we've structured deals to make sure that, because we don't know, 3 years, it could be a double dip recession. We feel like everything's going to get better, but who knows what could happen. But how do we kind of stay above it, or do we?
Yeah. To buy deals, you have to play offense, right? Nobody buys a deal if you're constantly on defense, but when it comes to your operations and your debt, I think it's just always being defensive. We've done a really good job with that as far as when we're, on our portfolio and when we're buying properties, we're always looking for flexible debt. No balloon payments, the longest term that we can lock up, the low rates of yesterday is what we targeted. And still, obviously going forward, we went the lowest rate and flexible debt. So, if rates go down, we have the ability to refinance and grab a lower rate. If rates go up, we don't have to refinance or sell because of, an upcoming balloon payment. I think that's the best way to protect yourself, is just, protect your downside and leave room for growth on the upside. But it's just all a function of risk.
Let's dive into our most recent deal. We talked about buying something all cash. How are we, in this environment? We're buying it in Q4 2020. As we record this, it's closing tomorrow. So what are some things we've done to mitigate risk on a deal like that?
So in terms of mitigating risk, what we're doing is we're really sharpening our pencils to make sure we know our CapEx reserves amount, what's needed for each unit. But in addition to fundraising and having a margin of safety, we're also making sure we know exactly what needs to be done. And then we're using the cash flow from the operations to help fund the CapEx, as opposed to raising, more operating capital. That will allow us to do our traditional value add strategy within the 2 to 3 year timeline that we usually do for our other properties. But that will also give us a lot of flexibility once our value add is completed for refinancing, seeing how the market is, and really mitigating our risk.
Yeah, Nick, I think the beauty of all cash is we get to pick the moment that makes the most sense for us to finance it, right?
Correct. Yeah.
Yeah. So that's in and of itself is an amazing risk mitigation strategy. Mark, what else is on your mind? Any last thoughts on different ways to look at this market, whether it's alternative investment strategies or mindsets or whatever? But any thoughts on as the seasoned, I'll call you the elder statesman of the group?
Yeah, thank you. I don't know that that's necessary, but I don't know. It's an interesting time. I think it's a time of, to be cautious, but also there's opportunity there. I think like all the strategies that were mentioned are good ones. I think, I think, was it Nick that you mentioned? Yeah, thankfully, we're seeing the benefits of what we've been doing for the past 4 or 5 years. Like we always put on fixed debt, in the very, very low interest rates. We've gotten, as low as 3%. So we're very comfortable right now. Like, thank God we're not in trouble. And I think probably a lot of operators are silently panicking or silently in trouble. And we're in a good position right now because we aren't in trouble. I think we'll be positioned well to take advantage of opportunities coming down the pike.
Yeah, I think those that went with the 75, 80% bridge debt with very short terms that were just going crazy. And it was funny watching it. It's like it'll go as long as the market continues to go, you'll be fine. But the moment the roller coaster stops, man, it's scary. And that you hate to see it happen to anybody, but it's the inevitability of what's going to happen in the next 3 to 6 months.
Yeah, they'll seem like geniuses until the market turns.
So I was going to talk about one last thing. Nick, you and I talked about it yesterday, but I thought it was worth mentioning. Like for our current portfolio, we should also see whether or not certain improvements make sense relative to what the bump is in rents. And if we're not going to refinance, it's better to hold on to the cash, kind of see where things land. And if the delta between the current rent and the rent with the improvement doesn't make sense, we shouldn't consider it.
Yeah, that's a good point. I mean, another way of playing defensive is, you're always keeping your finger on the pulse of your market and looking at your rent comps and where rents are trending. I mean, we started this year in Q1, 22% year over year rent growth, and we're ending the year at 8%. Right. So we did see some softening, throughout the year, unless you're in a gateway city where the migration trends have reversed. So it's, where we could be putting 25,000 into a unit and just doing, a really beautiful gut remodel and getting top of the market rents. Now we dial that back and play defensive and fill the units, maintain our occupancy, structure your lease exposure. I mean, we've had 2 years of very strong rent growth. Where you could pretty much put anything on the market and do a good job. So you got to be a lot more strategic moving forward.
I don't know. I had some bullet points. I think a lot of them have been mentioned. Strategies in today's environment. Number one, pencils down. A lot of people are doing that. That's very viable. Is sit and wait. I think there's a lot of opportunity there, but who knows? The prices may continue softening. Number two is invest around interest rates. Like you guys mentioned, it's going all cash or finding other ways to replace the debt, which has now become super high, or assuming as well. And number three, buying off market. I think that's becoming an opportunity now. And finally, number four, I would say just to consider all options at this particular moment in the economy is you could buy beaten up stocks. Obviously, the stock market is way down. So despite all the problems that the economy is having, there's also always a lot of opportunity at the same time.
Let us know what you think. What are you doing? What are you hearing? What's happening in your environment? Are you making additional plans, alternative strategies to purchase, or are you holding right now? Sharpening pencils, as we've talked about. So make sure you subscribe to this channel, like and comment. Let us know what you think, and we'll see you on the next edition.